It's time to go bargain hunting again. And this time we're going to go bargain hunting in dividend stocks. We're going to look in the energy industry. I'm Jason Hall. This is The Smattering. We're talking energy stocks. So that means I've got to have Tyler Crow on here with me. Tyler is the expert in that area. Before we get started talking about what we think is an absolute bargain buy, a reminder, our videos are sponsored by The Motley Fool. If you're looking for even more great stock ideas than the one we're about to talk about right now, go to our special link, fool.com/The Smattering. The Fool is going to give you its 10 best stocks to buy right now. Be sure to check out that link after this video. All right, Tyler, Equinor is the name of this stock. You and I know about it. I own some. You own some. What is Equinor?
Equinor is the Norwegian state-owned oil company, also publicly traded. It used to be called Statoil. It wanted to go through a nice renewable energy rebranding. They didn't want to have the word oil in it, but hey, whatever. Let's kind of put that aside for a minute and talk about why this business is attractive. One thing that Equinor has going for it is it sits in the backyard of one of the most profitable oil and gas fields in the world. It's the Norwegian continental shelf. It can be a little bit hard to develop sometimes because it is, North Sea can be a pretty rough environment. But once you get oil up and producing from that area, it's extremely low cost. A lot of Equinor's production in the Norwegian continental shelf, and that's the vast majority of its production, they can make it profitable and pay their dividends at less than $30 a barrel. When you look at that kind of level of profitability, regardless of what oil prices are today, they're going to move up and down, and stock's going to do that as a result. But a company that can produce oil that cheaply and have a disciplined capital spending regimen is going to throw off boatloads of cash. And that has really been the case with Equinor. They're sitting on mountains of cash and have been paying special dividends, buying back stock. And it's got like 30% of its balance sheet in cash right now. So when you start tallying that up and then comparing it to, say, like an ExxonMobil or a Chevron in terms of valuation, it looks incredibly attractive, even though it doesn't have the name recognition. And it's just kind of one of those ones flying under the radar, really.
There's a couple reasons why I think it's worth noting. So number one, it's certainly not as well known to the average retail investor, but certainly Wall Street's familiar with it. Analysts that cover the energy industry know a lot about it, but a lot of these European oil majors trade for a discount compared to their U.S. peers. We've seen that. And part of the reason is concerns about potential
they underperform.
That's
but
true.
This one
No,
doesn't.
That's a good point. That's a good point. So there's a couple things. So yeah, that's true. They do tend to generate lower returns. They tend to have higher cost bases, have not generated the kind of cash margins that we've seen from some of the U.S. producers. But there's also concerns about tax risk for windfall taxes and things that we've seen coming out of the Eurozone. And that's weighed a little bit on some of these oil stocks. And I think it's a reality to consider, as much as maybe it's more saber rattling and political commentary than maybe material risk. But at the end of the day, and this is why I own Equinor and why it's certainly, to me, really appealing as one to add to my position potentially, is that for the quality of its business, the cash it generates, what it's doing with that cash, and maybe more importantly, what it's not doing with that cash, and that's not going out to make splashy acquisitions or expand in ways that aren't cash generative. That to me says, if you want to buy in the oil patch, you want a high quality dividend, you want to own with a good margin of safety, Equinor is a buy right now.
Yeah. And just to add a couple numbers to that, to really bring this into perspective, I was saying about 30% cash. It's higher than that because it's $45 billion in cash and equivalents sitting on the books for a $96 billion company. So we're over 40% cash just sitting on the books. And it currently trades at a price to free cash flow ratio of 5.3 times. So when you look at something like that, there are few companies that you can find, very, very good balance sheet, throwing off a lot of cash, trading for a price to cash flow ratio that low.